Here are the crypto top headlines covered in this video. Fed pause is a green light for investors. Here's what it means for crypto. Next, Bitcoin ETF applicants will have to bend the knee on cash redemption model. Also, crypto regulatory discord, CFTC and SEC clash over jurisdiction in US. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. We are a new channel here on YouTube and would greatly appreciate it if you would click on the like and subscribe buttons as well as the notification bell. It does help support the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline, Fed pause is a green light for investors. Here's what it means for crypto. With the expectation of further rate cuts heading into 2024, analysts say this could be a positive boost for crypto stocks and investment products. A decision from the United States Federal Reserve to pause and possibly lower interest rates in 2024 will likely serve as a positive boost for cryptocurrencies and crypto stocks. In a December 13th interview with Bloomberg, BlackRock fund manager Jeffrey Rosenberg described the Fed's rate pause and hint at rate cuts next year as a green light for investors, with the S&P 500 rallying 1.37% on the decision. This bullish sentiment can go on for a while, at least until we get a new round of economic data, and until then, the message is clear. The Fed is more than willing to see an easing in financial conditions. Crypto stocks saw significant gains on the back of the announcement too, with shares of Coinbase and MicroStrategy spiking 7.8% and 5% respectively, while Bitcoin miner Marathon Digital jumped 12.6%. Henrik Anderson, Chief Investment Officer at investment fund Apollo Crypto, told Cointelegraph that he expects the Fed's pause and the expectation of lowered interest rates in 2024 to be a positive boost for cryptocurrencies and crypto-related stocks, adding, "If we see the likes of BlackRock and Fidelity launch Bitcoin ETFs, we can expect a lot of other traditional financial institutions to enter the crypto markets as well." Blockchain equities recently experienced their largest weekly inflows on record, with a staggering $126 million flowing into crypto-related stocks, according to a December 11th report from CoinShares. CoinShares head of research, James Butterfill, also found that digital asset investment products experienced their 11th straight week of inflows, posting a weekly gain of $43 million. Tina Tang, market analyst at CMC Markets, told Cointelegraph the Fed's rate pause would undoubtedly increase market enthusiasm for crypto products. The pivot boosted broad risk-on sentiment and improved expectations for future liquidity conditions, thereby buoying crypto stocks in the same manner. Tang said investors can expect to see similar bullish trends not seen since previous rate cut cycles, amplified by institutional interest in pending spot Bitcoin exchange-traded funds, which are currently slated for a decision in early January. However, Anderson added that a side effect of lower interest rates could be the cooling of the real-world asset tokenization narrative, with expected increases in decentralized finance, or DeFi, yields becoming more attractive to investors in a low-rate environment. A lot of the interest so far has been in tokenizing treasuries. We now see an environment where we can generate in excess of 10% yield in DeFi, while traditional yields are heading the opposite direction, he added. Like many market commentators, Tang and Anderson both looked to the upcoming Bitcoin halving in April 2024 as a significant catalyst for overall crypto market growth. Our next top headline, Bitcoin ETF applicants will have to bend the knee on cash redemption model. The SEC is pushing Bitcoin ETF issuers down the cash create route for creation and redemptions, but BlackRock has other ideas. As spot Bitcoin exchange-traded fund issuers iron out details of their filings with the United States Securities and Exchange Commission, the regulator appears steadfast in demanding a cash redemption model instead of an alternative model proposed by other issuers such as BlackRock. On December 14th, finance lawyer Scott Johnson said that ETF applicants Invesco and Galaxy became the latest to bend the knee to using a cash creation and redemption model for their ETF. The trust expects that creation and redemption transactions will take place initially in cash, read their updated S-1 filing with the SEC. The federal regulator has seemingly been pushing for a cash redemption model for spot Bitcoin ETFs, but some applicants, including BlackRock, have proposed using an in-kind model. What's the difference? An ETF can create and redeem shares in two ways: cash creation or redemption, and in-kind creation or redemption. A cash creation model is one where the authorized participant deposits cash in the ETF equivalent to the net asset value of the creation units to be created. The fund then uses this cash to purchase the underlying asset such as Bitcoin. For in-kind creations, the participant deposits a basket of securities matching the composition and weighting of the ETF's portfolio. This allows the fund to issue creation units to the investor without immediately selling the securities for cash. This model is seen as more efficient for ETFs as it avoids bid/ask spreads and broker commissions from selling the basket to raise cash for issuing shares. However, cash creation provides more flexibility for fund participants. Explaining the difference to an ex-user, Seifert said the cash model leads to slightly wider spreads, potential tax inefficiencies. It will be better than anything currently available on TradFi rails. Bending the knee. Bloomberg senior ETF analyst Eric Balchanas said the latest filing was a pretty big clue that SEC is dug in on only letting cash create ETFs out in first run, adding that he also heard this through back channels. He added that many were waiting to see if BlackRock could sway the regulator on in-kind creation. However, Seifert added, "I think everyone is going to have to bend the knee to cash creates and redeems." In late November, BlackRock met with the SEC to discuss ETF share creation and redemption mechanisms. It presented a revised or hybrid in-kind model design favoring that method over cash creations. Seifert also noted that Bitwise has been set for cash-only creates/redeems since December 4th, though for months they had in-kind or cash in their documents before this. On December 13th, the SEC delayed its decision on whether to approve or disapprove a spot Ether ETF for Invesco and Galaxy Digital. Moreover, representatives from several asset managers, including BlackRock, Grayscale, and Fidelity, have met with the SEC in recent weeks to iron out the final details for their spot BTC products before what analysts expect will be a batch of approval in early January. Our next top headline, Crypto Regulatory Discord, CFTC and SEC clash over jurisdiction in U.S. The U.S. crypto landscape remains in limbo as the ongoing turf war over jurisdiction between CFTC and SEC persists. With the United States struggling to bring about regulatory clarity for the crypto space, the ongoing discord between two pivotal watchdogs sparks concerns about potential implications. The head of the Commodities Futures Trading Commission, or CFTC, Rostin Behnam, has once again indicated that most crypto assets are considered commodities according to existing laws. He also acknowledged an ongoing turf war among regulatory bodies, particularly the Securities and Exchange Commission, or SEC, and the CFTC, regarding the jurisdiction to regulate the digital asset industry. Turf war. During an appearance on CNBC's Squawk Box, the CFTC chair clarified that, under existing law, many of the tokens constitute commodities, providing some regulatory clarity on the status of crypto assets in the United States. Highlighting the regulatory complexities faced by the crypto industry, Behnam emphasized the pressing need for legislative action, noting that members of Congress are actively working to understand the regulatory landscape. While the United States remains a prominent country for cryptocurrencies, alongside Australia and Brazil, the lack of regulatory clarity and consistent enforcement actions against crypto businesses are significant deterrents for enterprises operating in the region. Behnam pointed out the challenge of a turf war among various regulatory bodies in the country, specifically between the SEC and the CFTC, regarding which agency should regulate the industry. This ongoing conflict has become a major obstacle in establishing clear regulatory guidelines for digital assets in the broader crypto industry. The CFTC chair's perspective on crypto regulation differs from that of SEC Chair Gary Gensler, who consistently asserts that crypto intermediaries engage in securities transactions and should fall under his agency's oversight. Rift between SEC and CFTC. Between 2019 and 2023, the crypto industry in the United States directed $56.44 million towards lobbying efforts, with $20.2 million allocated in the current year alone, constituting 19.7% of the total expenditure on Wall Street, as per CoinGecko's estimates. Despite this considerable financial influence, regulatory watchdogs in the country, notably the SEC, have intensified their supervision, revealing a paradox where industry impact clashes with regulatory scrutiny. Reports of clashes between the two entities surfaced after Behnam urged Congress to assume a more central role in guiding federal agencies toward establishing a regulatory framework for cryptocurrencies. He then highlighted the historically effective collaboration between the two, but pointed out that the case for digital assets is unique. Contrary to the perceived discord, Dan M. Berkowitz, former SEC General Counsel and former Commissioner at CFTC, does not believe there is a rift between the CFTC and the SEC in regulating digital assets. While speaking with Crypto Potato last month, Berkowitz acknowledged the urgent need for Congress to grant additional authority over non-security digital assets in the spot market, while he admitted that some differences are normal due to their respective jurisdictions, but did not see them rising to the level of a substantial rift. So this concludes our top headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons, as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.